Good evening and welcome to the CARES Act tax update for churches presented by FlockBase software. Now, I believe most of you, if not almost all of you, are familiar with FlockBase software because you likely use it in your church. I'm assuming that we have some people out there who've been invited who are maybe new to FlockBase. So welcome. We're thrilled to have anybody who might benefit from this be within earshot. So I guess without further ado, we're ready to get moving here. Two presenters today. I'm Kevin Cheshire. I'll let Jerry introduce himself when he starts. As you can tell from this picture, he's the good-looking one. I'm just here for my brain, I guess. I'm not sure. But my name is Kevin Cheshire. I'm a partner with FlockBase Software. Jerry and I are partners in this venture. I've been in public accounting for since 1989, so I've been a CPA for about 30 years. And most of my career I've spent on a church staff in finance or administration at two different large churches. And I've also done some significant church and minister consulting. So this is something that I have spent my life in church work. And Jerry and I both have grown up in church, so we have a heart for the bride of Christ. And really, we just want to help you. And FlockBase is one of the ways that we believe we're helping build the kingdom. So here's our agenda for our session tonight. We're going to talk about the CARES Act, just a brief overview of the facets of it, hopefully enough to give you a little bit of basis to see and understand what might benefit you, what parts of this act might help you, and give you enough to get moving. So we're going to talk about payroll protection loans or grants, and these are things that will allow churches to apply for forgivable loans that can cover payroll and other operating costs. And if done correctly, part of these loans can be forgiven, so they would become grants. Secondly, we're going to talk about refundable employee payroll retention tax credit. Now, this is a tax credit. It's not a loan. It's a credit against taxes that churches can receive. It's up to $5,000 per employee retained. And this is part of all of this is trying to help businesses, including churches, keep employees in difficult times. We're also going to talk about deferred payments of a portion of payroll taxes. So those deferred payments can be extended out a significant period of time, and there is no penalty, no interest. There's not really a downside. We're going to talk about relaxed rules for charitable contributions. Since the Tax Act that happened late in 2017, very few people have actually gotten to deduct their charitable contributions on their tax return. Well, this act changes the rules for 2020 so that most, if not everyone, who gives to a charitable organization can actually take a deduction this year. We're going to talk about that. We're going to talk about reimbursement of unemployment costs for nonprofits. Now, this is not for churches specifically, but a lot of our clients are, not a lot, but some of our clients are nonprofits. So this relates to some of you. And unemployment is different in each state. So there may be some states that have different rules for churches. We don't claim to know the unemployment rules in detail for every state. Then lastly, we're going to talk about the mandatory sick family leave pay for employees. And we're going to just barely touch on that. That one topic alone could be more than 1 hour long webinar. And then at the very end, we're going to talk about or answer questions. So as we're going through, be thinking of your questions, and we'll do the very best we can to respond to them. And if we don't get to one of your questions, we will, after the webinar is over, we will get back to you. Now, some housekeeping. First of all, and this may be the most important thing I need for you to hear on the front end, this material has been prepared for informational purposes only. It's not intended to provide and should not be relied upon for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. So, said in a different way, this is for educational purposes only. This is not for transactional purposes. Second, please post your questions via Facebook Live. And then, as I mentioned previously, we will answer as many as possible at the end of the presentation. Hopefully, we will get through them all. And if you have a situation that is unique, we may ask you to send us more details in a private channel so that we can get back to you with best advice we can give. Next, we're going to try to please try to save your questions until after we've covered the topic. Hopefully we will answer many of your questions in what we cover. So wait until we get through with the topic to send a question about that. And then lastly, we are available for tax consulting and tax preparation. Jerry and I both have extensive experience and training in this area, but that is not for free. The webinar is completely free, but if you need tax consulting or tax prep work, we're thrilled to do that, but we do charge. We believe we are very fair in what we charge, but we do charge professional fees. All right, Jerry, here you go.
All right, thank you, Kevin. So we're going to start digging into the material, and we're going to talk about the CARES Act, of course. That's the sweeping, massive legislation that Congress passed and the President signed last Friday on March 27th. As you probably heard on the news 100 times over, it's the $2 trillion act. Now, the overall emphasis of that law is to provide relief for employers and individuals affected by the coronavirus pandemic. So it's two-pronged. It's going to help individuals with the stimulus rebate checks you've heard a lot about, but there's also many provisions that relate to employers, and we're going to cover most of those tonight because most of them also apply to churches. With respect to employers, what the government was trying to achieve here is they're trying to assist employers to keep their employees on the payroll. So as we go through these provisions, you will see that that is absolutely what they were trying to achieve. They're going to do that through a payroll loan that converts into a grant, and I'll cover that in detail. There's a payroll tax cut and deferment, and then also Kevin mentioned briefly the increased tax deductions for charitable contributions. Okay, when I stop right there, what you might say is, wow, it really looks like the government is trying to help employers, including churches. So maybe that brings up the question, should a church accept assistance from the government? And I think that's a valid question. I would not criticize anyone who asked that question, and nor would I pretend to answer that question for them either. So I think that's kind of a personal thing that each church needs to consider for themselves. You know, the leadership, the pastor, the elders, you know, that's something that for them to debate about. You know, are we willing to accept any assistance from the government? Because the government is absolutely offering assistance, so the church needs to decide whether they're going to accept that assistance or not. And I just wanted to bring up one little, you know, Bible story there about Rahab and the spies. You know, I know you're familiar with that, and I think through that story we can see that God can use anything or anyone to accomplish His purpose. So, you know, Rahab helped the spies, which in the end led towards a part of God's plan coming to fruition. So with that in mind, I don't carte blanche just write it off and say, okay, you know, a church should never accept any assistance, because the spies absolutely did accept some assistance, and it worked out for their benefit. All right, let's talk about payroll protection loans, or I'm going to call them PPLs. This is probably the biggest, most important, most exciting topic in this law, and there's going to be probably hundreds of thousands of businesses utilizing this law, and I think there's going to be lots of churches using this law as well. So the SBA, the Small Business Administration, is going to make loans of up to 2.5 times your average monthly payroll. So if I keep it simple here, if your church has $10,000 a month of average monthly payroll, you could get an SBA loan of up to $25,000, 2.5 times your average monthly payroll. There are no fees associated with obtaining this loan. There's no collateral required. This will be the easiest loan you've ever applied for and received. Now, if I stopped right there, you'd say, Jerry, we're opposed to borrowing money. And I understand that. I'm opposed to borrowing money too. But this is a very unique situation. So bullet point number 3, the balance of the loan is forgivable as long as you use the money for payroll, interest on a mortgage, rent, utilities, interest on other loans. So, and you read that right, it is a forgivable loan. So as long as you can later prove that you spent the money on these items, the balance of the loan goes away and you don't owe it anymore. So, you know, it's a vanishing debt. And I don't like debt, but I like vanishing debt. And so that's what this is. It's a debt that goes away as long as you use it for the intended items and in the intended ways. The bullet point there about the 8 weeks. So the funds must be used within 8 weeks of the loan date. So remember up top I said if you had $10,000 of average monthly payroll, you could borrow $25,000. Well, you need to spend that $25,000 within 8 weeks of the loan date on those prescribed items. And as long as you do that, you're going to get your loan forgiven. Now, we use the word payroll in a couple of different places. It's up there on the top bullet point that the amount you can borrow is 2.5 times your average monthly payroll. And then one of the items you can spend your money on is payroll. So we need to understand that payroll includes not just gross wages, but also includes payroll taxes and benefits. So, you get to include those items in your calculation of payroll, both for calculating how much you can borrow, and then you also get to use them in what you spend the money for. You can spend it on those items, and that will go towards your loan forgiveness. Now, I do need to let you know that payroll is limited to $100,000 annual salary total cost per employee. So if you have any employees who make more than $100,000, you can only count up to $100,000 of their salary in the payroll calculation. Bullet point number 2 there, to the extent loan proceeds are not used for the permissible expenses within the 8 weeks, the unforgiven balance carries the following terms. So 4% interest spread out over 10 years, and your first payment is not due until 6 months after the loan origination date. So let's just kind of think about that for a minute. Let's say you do borrow $25,000 because your average monthly payroll was $10,000. But over the 8 weeks after obtaining the loan, you only spend $24,000 of that on qualified items. And so $1,000 where you didn't spend it on qualified items, you would actually owe that money back. That's a loan that you now owe on. So you have a $1,000 loan that you have 10 years to pay back at 4% interest. So I suspect that most borrowers are going to spend all of their money on the qualified items within the 8-week period, and they're probably not going to owe anything back. But just in case you don't spend it all on the permissible items, you could have a small balance that then you have pretty favorable terms. Now, these loans are going to be available through June 30th unless the program runs out of money. And so Congress allocated $349 billion for this program. My guess is it will run out of money, and actually I'm fearful that it's going to run out of money very quickly. So even though I've got this bullet point that in theory the loans are available to be obtained through June 30th, in practicality the program may run out of money long before that. And unless Congress approves more money for the program, and that's not a given, then the program will simply be out of money, and there will be no more new loans made. Okay, so how do you apply for one of these PPLs, one of these payroll protection loans? Well, you must need to do that through an approved SBA lender. So maybe one of your local banks, or maybe your current bank is an approved SBA lender. Not all banks are, although this program from this law is going to fast track approval for new banks. So we think, even though maybe you have 10 banks in your town, maybe right now only 2 of them are SBA authorized. We think maybe in a few weeks more of them will be SBA authorized because they're going to apply and through the fast track program. But again, maybe 6 weeks from now all the money's gone. So if you really want to pursue this, we think you need to get on it pretty quick. You need to find an approved SBA lender. I know there are some online banks that do that. I think US Bank is one, and so you can search and try to find approved SBA lenders, but I would start with the banks in your area and then move out from there. One other little qualifying fact is that this is only available to churches with less than 500 employees. So if you're a church with more than 500 employees, you're not going to be eligible for the PPL, and you probably are also not listening to this webinar. Okay, continuing on with PPLs. So this is important. So you say up to this point, Jerry, this sounds like the greatest thing ever. The government's basically going to give us money to make our payroll for the next 2 months. And I know there's the other side of that is taxpayers, we will eventually pay for all of this because and I know there's really no such thing as government funded. There's only taxpayer funded, and I get that and pay a lot of taxes, and I realize anything that's drawn on these loans will eventually be paid back by all of us as taxpayers. But beside that point, it sounds like a pretty good program to get small businesses and small employers and churches through this crisis. So where's the catch? There's got to be a catch. Well, the catch may be a little bit in this first bullet point that says the borrower's certification. So that means someone at the church who has the authority to sign legal documents on behalf of the church. So that may be the head elder, that may be one of the trustees. Each church is maybe structured differently, but whoever it is at your church that has the authority to sign legal documents is going to sign a document that says, we are an eligible recipient because we're applying for this loan, and we're going to make this good faith certification that, number one, the uncertainty of current economic conditions makes necessary the loan request to support the ongoing operations of the church. So, in my particular church, I'm the volunteer treasurer at my church. Actually, our church is quite healthy at the moment. Our finance committee had set aside some money to carry us through rough times, and that money is there. And we have about half of our contributors are already signed up for online giving, so they're doing consistent, recurring online giving. So I believe my church is healthy, and I'm not for sure as the volunteer treasurer that I could actually sign this certification, because I think our church will survive and be okay and continue with our ministries, for many months to come. With good conscience, I'm not sure I could sign number one, but I'm quite certain there's other churches that for a variety of situations, their situation is different. But that's really the sticking point. To me, that's the only catch in this whole situation. Is the church comfortable signing this certification that this loan is necessary to support ongoing operations? Now, that doesn't say that you're completely out of money, and that you're going to bounce a check tomorrow. I think, there's some judgment there that, well, maybe we have enough money to last us 5 weeks, but in the 6th week we're going to be in trouble. Then you probably need to figure something out, because 6 weeks will be here pretty soon, and I'm not for sure all of this is going to be completely over in 6 weeks. I hope it is. I'd like for it to be, but I'm not certain that it will be. So, number one, that's the sticking point. If you can get past that, you probably should think about moving ahead. Okay, number two, you got to certify that you're going to use the money for the items that you're supposed to use it for. That's not a big deal. Just know that once you've borrowed the money, you need to use it for payroll. You can use it for sick or medical leave. You can use it for mortgage interest, but not principal. You can use it for interest on your other debts, but not principal. You can use it for rent and utilities. You also had to be in operation as of February the 15th, 2020. So if you're a brand new church that started up in the last 6 weeks, you're not going to qualify. You had to be in operation, with a bank account and operating as a church prior to or on February 15th, 2020. Number four, that you had employees as of February 15th, 2020, or independent contractors. So, as long as you were in operation and you had employees on that date, then you're going to meet all these other certification criteria. All right. We've used the phrase your average monthly payroll because that's how you can calculate how much you can borrow. So we need to define that a little more specifically. And what is your average monthly payroll? And you need to look at this look back period. So if you were in operation between February 15, 2019 and June 30th, 2019, this is the look back period you use. So if you were open as a church last year, a year ago, then you need to use, and you'll have to use the February 15th, 2019 through June 30th, 2019 as your look back period. So you would calculate how much your payroll costs were during that time period, which is 4.5 months. You'd then take the total, divide it by 4.5 months, and that would be your average monthly payroll for those 4.5 months. If you're a relatively new church and you were not in operation during that time period, then you would use January and February of this year. So if your church started last fall, then you would use January and February of this year for your average monthly payroll calculation. So let's look at this one little example. Between February 15, 2019 and June 30th, 2019, you had 3 employees. Their annual salaries, which includes taxes and benefits, were $50,000 for employee 1, $75,000 for employee 2, and $125,000 for employee 3. Your average annual payroll is $75,000, and here's how we calculate that. You see the $50,000 for employee 1, you see the $75,000 for employee 2, but notice on employee 3, we have to shave off the $25,000 to get them back down to the $100,000 cap. So employee 3, even though we really pay them $125,000, we can only count $100,000. So you'd really say that's 50 plus 75 plus 100, which is 225. You take 225 divided by the number of employees, so you'd have your average annual payroll is $75,000. Now, you take that and divide it by 12 months to get your average monthly payroll. So you take 75,000 divided by 12, and your average monthly payroll is $6,250, which means your maximum PPL, your maximum loan amount, is $15,625, which is the $6,250 times 2.5. Okay, the amount of forgiveness, so there's a couple of qualifications here. There's a chance that if you do these things, your loan forgiveness could be reduced by an amount. So bullet point number 1, the loan forgiveness will be reduced if your average number of full-time equivalent employees during the 8-week period after the loan begins is less than your average number of full-time equivalent employees before. So lots of legal jargon there, basically to say this: don't be laying people off during this 8-week period. You know, if you normally have 5 employees, you need to keep 5 employees during this 8-week period. If you do that, then you've met this test. But if you normally have 5 employees and you lay 2 of them off and now you only have 3, then you've failed this test and you could owe part of the loan back. So not all of the loan would be forgiven. Then another thing, so we're on bullet point number 2, the amount of loan forgiveness would also be reduced if the salary or wages of any employee is reduced by more than 25% below $100,000 when comparing the 8-week period after the loan begins to their wages during the most recent full quarter. So kind of the same concept. During this 8-week period, do not be reducing any of your employees' salaries by more than 25%. So if somebody's been making $1,000 a month, you can lower their salary to $750 a month and you're okay. But if you lower their salary to $740 a month, you've exceeded the decrease in salary by 25%. Now you're going to owe part of the loan forgiveness back. So I don't see that as a big problem, but I just want to make you aware. Basically, the government's saying we want you to keep your employees on the payroll, and we want you to keep paying them what you've been paying them before. And if you do that, then you've met all the tests. All right, I'm going to switch over now and let Kevin talk with you about the refundable employee retention credit.
Okay, I'm back. The refundable employee retention credit. Now, this is a 50% payroll tax credit for wages paid. What we've talked about up until now was a loan that could be forgiven if we meet all the criteria, which we believe are fairly easy to meet. Now we turn our attention to a tax credit. And churches that might have a hesitancy to take out a loan, I think that goes away on a tax credit because the way the law is written, and we are allowed to take the credit. We're not doing anything wrong. We're not doing anything deceptive. We're taking the credit. So maybe there's many more churches that might be interested in this. It might not have any negative appeal, negative repercussion. So let's talk about qualifications. Number 1, and this is one that we believe most churches, if not every church, meets, is that operations have been fully or partially suspended as a result of a government order limiting commerce, travel, or group meetings. Now, we're in Texas, and right now we're under a restriction not to have meetings of 10 people or more. And I presume that same limit is available or is mandatory in all other states or is similar. So we believe that churches automatically are going to meet that qualification. Now, if you don't, there's one other potential qualification. That is that you've experienced a greater than 50% reduction in quarterly receipts measured on a year-over-year basis. Now, for churches that have a lot of online giving, I think it's very unlikely that they will experience a 50% reduction in receipts. Churches that don't do online giving, I think it's more possible. But as long as we have mail service and other ways that people can drop off tithes and offerings, I think we're going to be okay for the most part and not see a 50% reduction. I certainly hope and pray that no church does. So those are the 2 qualifications. And let's also note that if there's less than 100 full-time employees, which most churches, the vast majority of churches in the United States meet this criteria, all wages are eligible. Now, if you are a larger church, if you have more than 100 full-time employees, only furloughed or employees with reduced hours are eligible. So those are the basics. Now, it is capped at $10,000 of wages per employee. Now, that can include health insurance. So if you have 10 employees, the cap could be $100,000 in wages. And the credit offsets the 6.2 matching portion of your Form 941 payroll taxes. This is what's commonly called the employer's portion of FICA, the employer's portion of Social Security. It's not what's withheld from the employee's pay, it's what the business matches. So that's what we get to offset against. Now the IRS has granted new authority to advance payments to eligible employers. Now it says here a new IRS form should be released soon. Now you can't see this, but I'm holding in my hands a draft that was released as of yesterday of a Form 7200. And I just looked at the IRS website a few minutes ago. It still says that the instructions are going to be available tomorrow on April 1st. They are in draft form right now. You can go to the IRS website and take a look at it. And this form is used to claim an advance credit for the employee retention credit, for qualified sick leave wages, and also for qualified family leave wages. So you can use that one form to get the advance if you need that. And that, like I said, that should be released tomorrow. That's what the IRS website says. So the IRS has granted authority to waive applicable penalties for employers as well who do not deposit applicable payroll taxes in anticipation of receiving the credit. So the IRS is going to grant you a little bit of relief. So they won't charge penalties, won't charge interest if you have to hold on to the employer's portion of Social Security in advance. So take advantage of that if you need to. That's a rare opportunity for the IRS to not charge a penalty or interest, but only if you need it. So more about the employee retention credit. Let's do an example. We have an employer that has two employees. We have Bob and we have Susan. Now Susan makes $5,000 per month. That could all be salary. It could be salary and other benefits, but her total compensation is $5,000 per month. Bob's is $4,000. So in the first month, if we add 5 and 4 together, we get $9,000. That's the total amount of eligible wages. We multiply by 50%, which is the limit of the credit. We get $4,500. That's the amount of credit that the entity can take in month 1. In month 2, it's exactly the same as it was in month 1. We have $5,000 from Susan's salary, $4,000 from Bob's, total of $9,000 times 50% is $4,500. Now in the third month, the math gets a little bit more complicated, but it's still not too complicated. After 2 months, Susan has reached the $10,000 limit. $5,000 in the first month, $5,000 in the second, so she reached the $10,000 limit. Now Bob, he has $2,000 left because he had $4,000 in month 1, $4,000 in month 2 for a total of $8,000. 10 minus 8 is 2, so he has $2,000 left. Eligible wages of $2,000 multiplied by 50% gets us $1,000. So in month 1 we have $4,500, month 2 $4,500, month 3 $1,000, and that is a total credit of $10,000, which equals the max that we can have for these two employees. I'm going to turn it back over to Jerry now.
Thank you, Kevin, about the employee retention credit. Just on a personal level, I mentioned to you earlier, at my church, I'm not for sure at the moment I could sign that certification on the PPL, that our church really needs the loan. But on this employee retention credit, I'm confident that we meet the criteria. I mean, the state has shut us down. We can't have our church meetings. And that was really the criteria. So we're going to take advantage of this credit. And I don't even feel like I'm not borrowing money from the government here. I'm paying less taxes because they're offering me to pay less taxes. And if they're going to offer for me to pay less taxes at our church, I think we will. So I'm confident this is going to save my church several $1,000s. And of course, we will put that to good use for the kingdom. All right, let's move on and talk about deferred payment of a portion of payroll taxes. So payment of the 6.2 Social Security matching payroll tax can be deferred. So that's kind of interesting, right? Normally, you hold out taxes from your employees' checks, and then you have to match their taxes. Well, under this new law for 2020, when you match their taxes, you don't have to pay that in immediately or even at the end of the quarter like you did before. So they're letting you defer the taxes, and the first half of your deferred Social Security matching taxes does not have to be paid until December 31st, 2021. Now, I'm not really strong in math, but that's about a year and 9 months from now. So they are really giving us a long extension of paying those taxes, and that's only half of the deferred Social Security tax. The other half is not due until December 31st, 2022. So, I mean, they're really being generous in giving us a long rope to pay these matching Social Security taxes. And this will apply entirely for all of 2020. So, I mean, even hopefully this whole crisis is over with soon. And so in December, I'm hoping we're back, totally everything's normal, but still you don't have to pay those matching Social Security payroll taxes until the end of 2021 and 2022. Again, like Kevin mentioned on the previous slide, there's no penalty or interest on the amount that you're deferring, and it's effective immediately. So it's effective with this week's payroll. Now, even though they're offering this to us, I do want to issue a caution here. If your cash flow is really tight and you're going to need this cash flow relief, then it's an option for you. But if you don't need it, I wouldn't defer the taxes personally. As a practicing CPA with hundreds of clients, I've just seen too many of my clients over the years get behind on their payroll taxes, and that's just not fun to be behind on your payroll taxes. So you're thinking, oh yeah, that's great, I can pay them at the end of 2021, the end of 2022, and then you get there and you don't have the money, and that's not a good situation. So I felt it was our duty to provide you with this information, and if your cash flow is super tight and you have no choice, then you can utilize it. But if you're just asking for my general recommendation, I'm really not incredibly in favor of deferring the taxes out that long. But you needed to know they were there, and so we felt like it was our duty to share that information with you.
All right. Thank you, Jerry. Let's turn our attention now to kind of the opposite side of this. We're going to talk about charitable giving for just a minute and the relaxed rules for deducting charitable contributions. Now, as many of you are aware, at the end of 2017, major tax reform happened, and basically at that point in time, the standard deduction was doubled. And what that meant for most taxpayers is they no longer have enough itemized deductions to be greater than the standard deduction. Very small percentage still itemizes. And unless you itemize, you don't actually get to deduct part of your charitable contributions, right? You don't get to deduct any of them if you don't itemize. Well, not true for 2020. For 2020, we have a $300 limit. You can deduct up to $300 of cash contributions to charitable organizations, and that is what we call above the line. So that means even if you don't have enough to itemize, even if you're taking the standard deduction, you can still deduct up to $300 in 2020. So this is going to impact everyone, every taxpayer who gives. If you give up to $300, you can take this deduction, and it's going to save you taxes. So that's great news. And this is only for 2020. The law will revert back to what it is now for 2021. Now, that impacts everyone. Another way that many people may be impacted is normally we have a 60% limit on the amount of charitable contributions that we can deduct. That is 60% of your income can actually be given and deducted in any given year. Well, for 2020, Congress has raised that limit to 100%. So, for example, just to keep the math easy, if your income is $100,000 and you have the ability to give $100,000, you could do that, and you could deduct all of that on your 2020 tax return. So that probably not going to be a lot of people that benefit from that, but hopefully that will incentivize some people to make larger contributions to help charitable organizations live through these tough times. I think that could be very significant.
All right. Thank you, Kevin. Yeah, on those charitable contributions, at my church the last couple of years when I give out the year-end and mail out the year-end contribution statements, had several of my members say, Jerry, I'm not itemizing anymore, so it's not that big a deal that you give me or mail me my, charitable contribution statement. Well, for 2020, you can tell them, hey, you can use the first $300 even if you don't itemize. So everybody's going to want and need their contribution statement next year because all of your contributors are going to be able to claim up to $300 above the line. So that's going to save them a little bit of tax, not going to save them a ton of tax. Whatever it saves them in tax, they can put it to good use. So they can, do something for the kingdom with that money if they like. All right, let's talk about reimbursement of unemployment costs. So, as you probably know, most churches are exempt from paying unemployment tax. Now, I'm not saying every church in America, there may be some unusual situations or circumstances out there, but generally speaking, most churches in America are not paying an unemployment tax. Therefore, most church employees are not eligible for unemployment benefits based upon their church income. So, it's kind of good that the churches don't have to pay into unemployment. It's kind of bad that church employees can't draw unemployment based on their church income. Now, you may have some church employees who also have a second job, so maybe they're part-time at the church and part-time somewhere else. So they may still be able to draw unemployment off of their other job, but not off their church income. Now, even though this is all true for churches, nonprofits, so other nonprofit ministries that are not churches, many of them do pay into unemployment. Therefore, their employees are eligible for unemployment benefits. So now, for about just the next 2 minutes here, I'll be talking to nonprofits, not churches. So nonprofits have a choice about how they pay into the unemployment system. They can pay in a flat tax rate, which is what most of them probably choose to do, or nonprofits can choose to simply reimburse the state government for the unemployment taxes that are paid out on their laid off workers. And so if a nonprofit has chosen that method, that they're just going to reimburse the state unemployment fund for any unemployments paid out on a laid off church worker, this new law says the feds will reimburse the church for 1/2 of that cost. So I've got an example down there at the bottom. An unemployed nonprofit employee draws $10,000 of unemployment benefits. The nonprofit then has to pay in the $10,000 into the fund because they're one of these church or one of these ministries or nonprofits using the reimbursement method. But under this new law, the feds will reimburse the church that $5,000, which is 1/2 of the unemployment.
Okay, we've only got one more topic, so we're rapidly getting ready to wrap up here. We'll talk about mandatory sick/family leave, just very briefly. Now, this is mandatory for all employers with less than 500 employees. And with only rare exceptions, that's going to include every church in the United States. So there's an exception. This doesn't apply if these exceptions are met. Number one, you have fewer than 50 employees. And we take that to mean 50 full-time equivalent employees, not 50 different people, but 50 full-time equivalents. That may be a different answer, but that's going to cause most churches in America to qualify. So you can get the exception if you choose to, and you have to meet the other criteria as well. And the policy would jeopardize the viability of the business as a going concern. Now that's accounting lingo, accounting terminology. A going concern is a business. And what that really means is that you believe that this policy would jeopardize the ability of your church to continue to operate, that your church would have to shut down if this were applied to you. So fewer than 50, and that it would jeopardize the viability of you continuing to operate. And then one of these three also has to be true. That providing the leave would cost more than the church's available revenue. You just don't have the ability to do it. Your revenue that's coming in is not enough. Or the loss of workers on leave would be a substantial risk to the church's finances or operations. Very similar to the second requirement above, but slightly different. The workers that you would lose, that you really need them. You need them specifically. And then thirdly, the other or is that you don't have enough available and qualified workers to replace the employees who are on leave. Maybe you have some highly specialized, highly skilled workers, and you just can't find replacements for them. So you can apply for an exception if you meet those criteria. I don't know that you should, but you can apply for that exception to have this not apply to you. Now, payroll tax credits will reimburse the amount of leave wages. So this is probably the reason that you should seriously consider not choosing to get an exception. Because if you keep people, the people that are on leave due to COVID-19, if they meet the criteria, then the government's going to reimburse the church for the wages that you have to pay them on the sick leave. And that has limits. And those limits are just in general, there's a limit of $511 per day for the first 10 days. And then beyond that, it's $200 per day. And this is a fairly complicated part of the law. There's a lot of facets to it. So there are additional details available using these two links. And that is all we're going to cover today on the mandatory sick family leave. If you want additional information, you can go to the Department of Labor website and look at these two articles, and they're very comprehensive. So you should spend some time looking at that.
Okay, so quickly, I want to talk about online giving for just a moment. If your church is already doing online giving, that's great. If your church is not yet doing online giving, this is probably the time to implement that, since you're not able to have services and collect your offerings there during your worship service. So we just want to give a little advice on that as you consider who your online giving service provider is going to be. There's a couple of key things you want to look for. First, you want to understand their monthly fees. And the two, you want to understand their discount rate, which is what they charge you on each transaction. So you want to weigh those out, measure those out, and see which one is going to be the most cost effective for your church. As you know, FlockBase is a software provider, and we do have a relationship with a merchant processor called Forte. And Forte is very favorable rates. We use them at my church. We have about $5,000 per month coming into my church through online giving, and our monthly fee is $22. So, we're paying a $15 flat fee to Forte, and then we're paying a per transaction fee on the ACH giving. We've trained many of our contributors to give exclusively through ACH, so the fees are quite low. If there are other competitors out there, they charge a 2.89% flat rate or a 2.69% flat rate, and they don't charge a monthly fee. So on the surface, you hear, oh, no monthly fee, that's got to be great. But of course, if my church were using one of those providers at 2.89% per on each contribution, and we're receiving $5,000 a month in contributions, we'd be paying $144 a month. So, our church is saving a ton of money by using Forte and training our folks to do their online giving through ACH or the e-check system. There's a little bit of information about the pricing and features of our software. Many of you are familiar with that. On the left-hand side is the desktop features, and on the right-hand side is the cloud. Now, we know that many churches are struggling right now, and so we want to do our part to help out. So we want to stand together with churches during their time of need. So for new cloud customers, you can use the coupon code Stand Together, and you will receive free cloud service through June 2020. So whether you sign up for the basic tier, the plus tier, the pro tier, it's totally free through the end of June. We just want to help churches out. If you want to use online giving, you do need to sign up for the plus tier or the pro tier. If you're an existing cloud customer and your church is struggling, just email us and let us know, and we will cancel your fee. We will let you use the software for free through the end of June as well. So we're quite serious about doing our part, to help out churches in need. Now, if you're an existing customer and your church is not in need, we'd appreciate you continuing to pay, because that allows us to stay in business and provide these services to the churches. All right, I think we're on to the Q&A section now, and I saw a couple of questions posted about housing allowance and whether that will qualify under the PPL, the Paycheck Protection Loan. So let me say this. This law was passed last Friday, and I spent most of my weekend, much more than I should even admit, of my weekend studying this new law. So I'm a CPA with an accounting practice, and we're trying to bring all of our clients up to date about this new law. So there's some things we do not yet know. In fact, the PPL loans, you cannot actually apply for one today. The official application for the SBA has not been released yet. I've seen one draft. I don't even think the draft is correct. So it's going to be probably at least Friday before they're going to release the official PPL loan application. So having said that, there's still a few things we don't know. And we do not yet know if housing allowance will be counted towards payroll. I personally believe it should. I think that would be Congress's intent. But sometimes Congress's intent gets lost between their intent and how the IRS actually implements it. Or in this case, I'm sorry, because I will apologize, this PPL loan is not an IRS issue, it's an SBA issue. So the SBA will be making the rules about how to implement this PPL loan. And I think there is a chance, although I hope not, that when they roll out that application, they may not make a provision to include housing allowance in there. And that will be a shame, because I personally don't think that was Congress's intent. But unless there's somebody who's familiar with housing allowance drafting this application form, I do think that possibility exists. That will be quite a shame. And if that's the case, maybe if the lobby is strong enough, maybe that could get corrected or clarified or something. But we're going to have to wait and see how the application reads to see whether the housing allowance is going to be includable in the payroll calculation for the PPL. I certainly hope it is. And then another question I saw came in was about whether this PPL, this payroll protection loan that I've described, is the same as the disaster loan that's on the SBA's website. It is not. It is not at all. So what you're seeing on the SBA's website right now is an application for their disaster loan, or sometimes it's called the EIDL, the Economic Injury Disaster Loan. And churches are not eligible for this new Economic Injury Disaster Loan. So that's why we left it out of this presentation. Now, nonprofits are eligible, but not churches, not religious organizations. So if you're a business owner listening today, maybe you want to check into that EIDL, the Economic Injury Disaster Loan, but churches cannot. So for the PPL, my recommendation is to contact your local banker, find an SBA lender, and tell them you want to be on the PPL list. And as soon as the applications are available, you want an application, you want to be able to fill it out. But it's not, you can't go to the SBA website right now and get the application. It's just not there.
Okay, Jerry, we have another related question about housing. The question is, my church has only one employee, the pastor, and most of his salary goes to housing allowance, and he has self-employment exemption, which I presume means he has filed a Form 4361, so he's not subject to SE tax on his ministry income. Will my church be able to apply for the PPL loan?
Okay. Yeah, the fact that the pastor has opted out of the Social Security system is not going to have any bearing here, so we can just kind of remove that from the equation. But we're still uncertain about the housing component. So again, I'm hopeful but not certain that we can count housing in the calculation of payroll. Now, you said most of his salary was housing. So I would assume that means that there's a portion of his salary that's not housing, that's regular, that's wages. Now, we know he's a minister, so it's not regular wages, it's ministerial wages, and I get that. But ministerial wages will count. So let me just give an example. Let's say your pastor's salary is $30,000 a year, and he's getting $20,000 of that as housing allowance and $10,000 of that as a W-2 salary. Now, we know ministers, even though they get a W-2, you're not holding out Social Security and Medicare, so on their W-2 you only fill out box 1, you don't fill out box 3 or 5. But that ministerial wage in box 1, I am quite confident is going to count as payroll. So housing is still undecided, but ministers' wages that gets reported in box 1 of the W-2, I'm confident is going to qualify.
So, Jerry, I want to be sure that I think I mentioned this earlier. The Form 7200 is what a church could use to get advance payment of employer credits. So in a situation where the only employee is the pastor and the church does not match any Social Security, they could get reimbursed for the employees, the salary, using this form, even though they don't have any obligation.
Yeah.
Is that the way you see it?
Yes, and you're referring to the employer retention credit. So I agree. So using my illustration, so if the pastor's total package is $30,000, but he takes 20 of it as housing, the other 10 is W-2 wages, box 1 wages. That wage component, I am confident, is eligible for the employer retention credit, the 50% credit against the wages. But as you've indicated, if this is your only employee, you're not paying any matching Social Security. So you need a method of being able to get that credit back. And that's what that Form 7200 that you've referenced is going to allow us to do. It's going to allow you to file and receive a refund of credits that you don't have to file on the Form 941.
Okay, the next question is, what time period is the payroll for the employee retention credit? And I believe that begins April 1.
Yeah, I think it's immediate, and so I think April 1's tomorrow, so I think we're pretty good there. So.
Yes. So that's when it
Yeah,
begins.
the only thing I want to say about that employee retention credit, you cannot take it and the PPL at the same time. So if you're going to use a loan from the government, a forgivable loan, to pay your employees for 2 months, that's fine, that's great. That's a big help, a big benefit, that the government's offering to us. And then separately, they're offering us, a 50% credit towards our employees' wages if we retain those employees. You can't do both at the same time. That'd be double dipping. Now, can you do the employer retention credit after you've finished up the 8 weeks on the PPL? I think you can, but I'll be honest, this is, developing every day, and we've got new guidance from the IRS being issued every single day. So I cannot give you 100% guarantee that's the case, but I do believe and hope that after you finish up your PPL, then you could start in with the employer retention credit. If your church is not going to do the PPL, your employer retention credit starts tomorrow.
Okay. Next question is, will there be a handout of the presentation? We've gotten that question a handful of times. The answer is yes, and our apologies. We intended to have that posted before we got started tonight, but we just did not get that done. We will get it out there on our site, so you will be able to see the presentation. And there will also be a video of this posted, so you can share it with your friends if you want to.
Absolutely, yes. If maybe you joined us a little late and missed the first part, or we know some folks have trouble with their audio. We're watching our church service from home, and the internet at my house is strong, but my neighbors, they're saying, hey, our audio's not strong enough. And so, not everybody has fast internet, but you can watch this over and over again. It will be saved 2 places. It's going to be saved on our Facebook page, and it will be saved on our YouTube channel. So you can go back and watch it at your convenience at any time. And then you can also send it to your friends and neighbors that are involved in ministry. And even, most of this information we've presented will help small businesses too. So if you know small business people, they may benefit from this information. Feel free to share this. Free information. We hope it's, helpful to everyone. And yes, those handouts will be posted to our Facebook page. And so you'll be able to look down in the comments. There'll be a link there. You can click them and it'll pull up the handouts.
Okay, Jerry, the next question is, must PPL proceeds be placed in a separate account to facilitate tracking expenditures? I don't believe I've seen any requirement that be the case, but that's a great idea.
Right. Yeah.
It would provide much better tracking if you ever had to prove what you did with the funds.
Yes. That's a great question. So, by asking the question, I can tell you're exactly tracking, what the requirements are. So you don't actually have to do that. You don't have to keep it in a separate bank account. So if we ever get audited, what you would just simply have to do is you have to prove that you spent money on those items. So if you got a $25,000 loan during that 8-week period, you would have to, if you got audited, you'd have to prove to the government that you spent $25,000 on payroll, rent, utilities, interest on the mortgage, interest on the other business loans. So as long as you could do that with check copies or bank statements, it doesn't really matter which account they come out of. But I will agree with Kevin. If you do put it in a separate bank account, it'd be very easy to know, okay, how much do we have left of the PPL? And you'll know when you've spent it all. So not an absolute requirement, but maybe an okay idea.
Yes, and even if you don't want to open a separate bank account, if you're using FlockBase, you could easily create a separate fund. And that would allow you to track the expenses and the revenue without literally having a separate bank account.
That's right. So as you know, one of the strengths of FlockBase software is that you can track funds. And so, you could set this up as your PPL fund, and when you receive the money, you deposit it in there, and when you spend the money, you take it out of there, and when it hits zero, you'll know you've spent it all.
Yes, I think that might be very helpful for some people.
Yeah.
Okay, the next question is, what if the remaining payment after housing allowance is self-employment? So I think the question is, if we're giving our pastor housing allowance and then we're treating his salary as if it were self-employment income,
Mm-hmm. Okay.
but it's so small it's not taxable, is there any help?
Okay. Yes, so I think I understand the question. So let's try to use an example here. Let's say we have a pastor who has a $30,000 total package. $20,000 of it is housing, and 10,000 of it is salary. But your church is giving the pastor a 1099 for that 10,000 instead of a W-2 for that 10,000. So just as kindly as I can, I want to help you understand you're really not supposed to do that. And you may have done it for 30 years, and that's fine, and I'm not upset with anybody. But if you read, and we study church law all the time, tax law. I've just done this for so long. When you read the technical readings of the tax law, a minister should get a W-2, not a 1099. A minister of a local church. Now, if you have an evangelist come in and do a revival, yes, they can get a 1099. But the minister of your local church is supposed to get a W-2. And we have, if you go look at our YouTube channel, we've got our year-end tax update that we posted in January. And we go for about 30 minutes and we explain all of that in detail and exactly how it works. So, a minister is supposed to get a W-2 for everything except for their housing allowance. So in our illustration, we've got 30,000 total package, 20,000 for housing. We've got 10,000. That should go on the W-2 in box 1. It doesn't go in box 3. It's not subject to Social Security withholding. Or box 5, it's not subject to Medicare withholding. I totally get it. I do scores and scores of minister tax returns. The minister pays his own self-employment tax, but he's still supposed to get a W-2 in box 1. So a W-2 box 1 is going to qualify you for the PPL. If you're giving the pastor a 1099 instead of a W-2, we don't know yet. So that will be asking the question, so I pay somebody contract labor, can I use contract labor to qualify for the PPL? There are a couple of references in the law that make you think that might be true, but I have not seen enough that confirms that to me. So as of today, I'm saying I do not think that contract labor qualifies for the PPL, but I could be wrong. So this is one of these things that's continuing to evolve, and I could be wrong, and maybe contract labor does qualify for the PPL. So you'll have to keep your eyes out for that. But honestly, for 2020, if you're following my recommendation, you're going to report that pastor's wages in box 1 of the W-2, then it definitely qualifies for the PPL.
Yes. You can't see this because we're just showing you a screen share, but Jerry gets really excited talking about this. He's leaning in. Yeah. This is right in his wheelhouse.
Yeah, I get excited about tax. I know I'm weird.
We have one more question, I believe. I'll check again after we do this one. What if the housing allowance is mentioned on box 14 or in box 14? Will that make a difference or be acceptable with wages? And I think that's really just a continuation of the question earlier, which is outstanding, of housing allowance. Is that included or not?
Right, yeah. And whether you put it in 14 or not is not going to be significant. Putting it there doesn't help you, doesn't hurt you. That's that box is optional anyway. You don't even have to show your housing allowance in box 14 on the W-2. For myself, I actually put it on a separate letter. I don't put it in my box 14. I just write a separate letter, Pastor, here's your housing allowance for the year, because there is absolutely no requirement in the tax code whatsoever that the housing allowance be reported to the pastor, really in any way. Now, it's a courtesy, and you should, as a courtesy, and box 14 is fine. I don't have any problem putting it in 14, but it's certainly not necessary, required, or would it change anything? Because I'll give you the honest truth. The IRS doesn't read box 14. You could write Mickey Mouse in box 14, and the IRS would not even laugh because they don't read it. The box 14 is basically never, ever looked at by the IRS. So anything you put in there is just information between you and the employee.
Okay. Well, we're coming up on the top of the hour, and I believe we have answered every question, unless I missed one. So at the end of our feed over here, we've got a note that says the handouts are there. There's a link. So take a look at those, and as Jerry mentioned earlier, please feel free to share them. We believe that many of the churches that use our software, the actual user of the software is part-time or probably even a volunteer, which means you've got another job, or maybe you're retired, but it's very likely that many of you directly can benefit from this information in your job or in your business. So hopefully this has been helpful to you. It's our pleasure to get to do this. And I know Jerry gets really excited about this, and I do too. And I know that I could not do this without him. he's really the guy who writes all this and does all of it and hands me a script, and I get to read my parts.
Well, hopefully we make a good team. And I tell you what, we are sincere when we say that we appreciate you folks, because as Kevin mentioned, we recognize most of the folks we deal with are volunteers. So here you are on a Tuesday evening, volunteering more of your time to learn about taxes, to help out your church, to help out the kingdom. And so we sincerely appreciate you. You know, I'm the volunteer treasurer at my church. You don't get a whole lot of thank yous for that job. So I want to thank you tonight for doing that. Thank you for volunteering and doing the service you do for your church and for the kingdom. And hopefully you can sense that we're trying to come alongside you and be a benefit to you. So post us any additional questions there, and we'll make sure we get all those answered. And we hope you have a wonderful evening, and talk to you soon.
Yeah, stay safe out there.
Absolutely.
We're signing off.